thank you for joining us once again here at Seafried and Brew for our economic briefing. I am Jamie Sumner, the Chief Analyst, and for this briefing, we want to look at some of the releases that have come out over the past 2 weeks. Some of them have been fairly significant, and the impact to the market has been significant as well. So first, let's start off with the GDP number. And as we can see, GDP grew in the second quarter by 2.1%. That was above expectations. We thought it would come in below 2%. And so this 2.1% growth rate is a positive for the economy. Overall, we saw the consumer segment contributing 285 basis points to that growth rate. Very significant compared to what we saw last quarter when it was contributing just 78 basis points. That we saw both growth in pretty significant growth too in the services and the goods sector there. When we look at the investments, however, we saw that investment category being a negative carry on the overall GDP growth rate by the tunes of 100 basis points. That, for the most part, the lion's share was the impact to inventories and the negative impact of inventories, the inventory reduction there. But also we saw a continuing negative carry on the residential fixed investments. And for this quarter, the first time we've seen this in a while, we saw a negative carry on the non-residential fixed investments. So we saw that number come down, particularly in the structures. So we're just not seeing the investments from those businesses. And that most likely is due to the fact that they're unsure of what is coming next in the economy. Will there be a recession in the next 2 years? And if they make those investments, will they receive the benefit fully from those investments? So that's holding those corporations back from making those investments. Overall government spending, we can see, contributed 85 basis points to the overall GDP growth rate. And we continue to look forward with the spending plans that have been coming out, potentially seeing that continue to move up. And the exports, imports detracting from that growth rate by 65 basis points. So we see where this trade war might take us in terms of how these different numbers will fare over the next 2 quarters when we're thinking about the second half of 2019. Will the consumers continue to increase their spending and support the economy? Remember, 70% of the economy is built off of that consumer spending. And then also, how will the trade wars impact that import-export number? So with that, we look at also the inflation number with the core PCE. When we look at core PCE, you can see it increased slightly. When we look month over month, the growth rate was 1.6% year over year. Expectations was 1.7, so we came in slightly under expectations. When we look at the 5-year forward inflation expectation rate, we can see overall it came down over the past couple of weeks. This weighing in on the market, and with the comments of the trade war and how that's been moving along, we saw the impact in the overall market. And we'll talk about that in just a minute. But when we look at the Fed release, they continue to show that there's a positive improvement in the economy. They say it continues to has been raising at a moderate rate. All right, household spending has improved. However, business investments have been soft, and we've seen that in the numbers. We knew, or we had expected them to reduce the rates by 0.25%, and they did just that. What we weren't expecting was the change in their language, where they're going to stop the reduction of their balance sheet starting in August. So that was planned to happen in October, and now we're jumping 2 months earlier and stopping that reduction of the balance sheet. And that's going to weigh in on the overall rates, because now they're no longer reducing down their portfolio, so they're buying that paper to continue to reinvest those cash flows, which would make the rates go down, and that's in fact what we've seen. Overall, when we look at the unemployment rate, it continued to be at that 3.7%. Unemployment rates remains very low in here. When we're looking at the implied Fed funds rate, so this is looking at the market and the market digesting all the information coming back at them, and then thinking about where the Fed funds rates will be in the future. When we look out to the next meeting in September, 55% expectation of another 25 basis point reduction in rates, and then a 44% probability of a 50 basis point reduction. So that's fairly significant when we look at that, but with the numbers coming out, inflation continuing to be soft, that 25 basis point is more likely gonna happen. When we look at then in the October, they build in another 25 basis points. And then we look at in December, a 42 basis point or 42% probability that the Fed funds rate will be between 125 and 150. So we can look at this schedule and say there could be 3 more rate cuts by the end of the year. That's very significant and to me kind of worrisome. I think this is really aggressive. And here I could see 1 more, maybe 2 rate cuts as far as a need, but 3, I don't think that's needed. And I think that's getting into a dangerous area with the overall market, and can hurt significantly the banks that we work with in terms of asset yields coming down. Deposit rates will follow suit. They will come down, but I think they don't have as far to go as the asset yield. So that's going to be a big player. Plan on 25 basis points, maybe 50 basis points throughout the end of the year. We should be modeling this kind of scenarios into our ALM models in order to see how our income reacts to these scenarios. But when we look at the overall Treasury curve, this is looking at where we were at the end of 2018. This green dotted line here would be where we were at the end of the quarter, the second quarter, so the end of June. And we can see the movement we've seen between the end of June and the 2nd of August. Overall, we've seen downward momentum on rates when we look from the beginning of the year and from the end of the quarter. And we had a 10-year at a 186 on the 2nd. This morning, the 10 years into that 170. So we continue to see this downward pressure on the overall market. But we have this negative slope in the yield curve, this inversion that we see, and this would suggest that moving forward, that short end of the curve should start coming down. When we look at the forward rate, or the forward curve, we can see this is the current spot curve as of today, August 5th. And then we can see this downward momentum on that short rates throughout the next 12 months. So this is the type of scenarios we should be putting in to our ALCO models in order to see how will the income react, how our deposit rates and our asset yields react in this downward scenario on the short end of the curve. The long end of the curve has some movement going up, but not significant. That's what we have for you today. We look forward to speaking with you next week. We're going to look at the performance of the Community Bank Benchmark Group for the second quarter in our next briefing. Have a great day, everyone.